Hello everyone and welcome to this episode of Hardman Talks. I'm Larissa Adams from the Marketing and Investor Communications team at Hardman Co. And today I'm going to be speaking to Mike Foster, Hardman's real estate analyst, on his updated publication of the Safe Harbour REITs thematic notes. The note was written to introduce investors to REITs that are providing both stable and rising income with returns that are more resilient than the broader real estate sector. For investors looking for an entry point into a clearly defined subset within UK real estate, Mike's Secure Index, comprising of 17 REITs, is one to look at. This year, the index has outperformed the top 100 UK shares index in 7 out of the 10 months in 2020. And although the index has taken a slight dip this year, the top 100 UK shares index fell just over 12% more than our Secure Index. But resilience aside, let's get into why this basket of REITs is so attractive for investors looking to prioritize income. So Mike, can you explain more about the income stream the index of REITs is providing, particularly the expected dividend payouts and how the dividends are derived, and why this is designed perfectly for both the retail and institutional investor?
Yeah, sure. Thanks, Larissa. I'll start on the last point as to why it's good for a number of different classes of investors. Effectively, investors, both institutional and private, we believe are concentrating more and more on income because it's the income support that actually, after all, provides the capital valuations. And it's also income which a lot of private investors are seeking. Either for their retirement or just to boost their cash flow. And institutions are finding it more and more difficult, as are private investors, to find that income to match their liabilities. So in this basket that we put together, the average dividend yield is 4.5%. That's even after the recent rise. And I think more importantly, the dividends in all but 2 of the REITs in this basket are rising this year. The 2 are actually in student accommodation REITs, which we will talk a bit more about later. But putting those to one side, all the REITs are showing increased dividends, which is in marked contrast to both the FTSE 100 and the broader real estate sector. How are they doing that? Well, the REIT is comprised, as Larissa, you said, 17 stocks. 68% of the income comes from either the government or from supermarkets or from logistics. And the rest is also in areas that we deem are relatively, you can never be absolute bomb-proof, but relatively secure. So that's quite a good starting point. The second point is that 50% weighted and 60% unweighted of the income comes in a form that is indexed to the RPI or the CPI. And that's partly because they're coming from such resilient parts of the economy, but partly because both the REITs and the occupiers are looking at very long-term leases and staying in these buildings a long term. So just to summarize, it's great because it provides that sort of base of the right sectors, and also these tenants stay in the properties a long time.
So from the reports, you mentioned capitalizations at that time of the basket was sitting on £12.76 billion. So how important is liquidity to real estate investors right now? And what comments can you add about the liquidity of this basket?
Yeah, it was about 3 years ago that we first initiated the basket because we thought it would suit an investor need. The market cap now, because the market since the report was published has had a boost, as we all have, from the vaccines news. So the market cap is now 14 billion, which is an all-time high for this basket. And partly that all-time high is because 1.35 billion of new money has been raised in 2020. And that's almost exactly the same amount of new money that was raised in 2019. So the liquidity is partly because the market cap is pretty high. Virtually all the stocks are over $500 million market cap, and there's three that are either side of 2 billion. But it's because there's new flow of money coming in. And I think that new flow does two things. Firstly, it does increase the liquidity. There were 8 secondary issues and 1 IPO, but also it shows that investors are looking for these sorts of outlets to put their money into. And so the REITs would not have been able to have these follow-on secondary issues if there hadn't been a good underlying tone to trading in the existing stocks.
Great. So we touched on the resilience of the index at the beginning of the video, and there's an important graph on page 3 of your note highlighting that. So can you expand a little bit more on it?
Yeah, thanks. Yes. In a nutshell, that's out of date because the market's gone up quite a lot since the note was published. So it's actually good news because we've got a fairly secure index here that outperformed massively during the first lockdown and market concern or turmoil or panic in March. So it proved its worth on the downside. Over that whole panic period, it fell by about 15%, which was pretty good compared to the market as a whole, especially good because it was from an all-time high at the end of 2019. In 2019, it outperformed a rising market. So the FTSE in 2019 did go up about 5 or so percent. This sector went up by nearly 15%. So that was in a rising market. I just said in a falling market, it outperformed. So what's happened in the past month since we published this report, the index has gone up by nearly 10%. So the top 100 shares obviously have had quite a good bounce, but not much over 10%. So they've almost kept pace with the rising broader market after having held up better. So if you go year to date 2020, the FTSE 100 is still down by the high teens percent. This sector index is down by about 2%. So actually, if you roll up the income that you've received, because bearing in mind the dividend yield is 4.5%, which is well above the FTSE 100, rolling up that income, you are actually at an all-time high, not only in market cap, but in the value of the pound that you originally invested. It's at an all-time high with rolled up income.
Very encouraging. Okay, so you mentioned in your report one of the most important elements of the investment case is the value for money. So let's just talk about that.
Yeah, sure. If we look at the top, we'll look at it broadly in a minute, but if we look at the top half dozen or so stocks in the index by market cap, the biggest is Tritax Big Box. That's a logistics business that is integral to the distribution chain of lots of things, not just internet shopping, but the cost of the logistics is a very, very, very small part of the whole distribution chain. So although these are the tenants for Tritax Big Box are on a mixture of leases, the lease income, the rents are going up. So it is value for money. The rents are going up and it's not a large part of the whole cost. The next two in market cap invest in GPs surgeries. Assura and PHP have both been around as long as Tritax, which is over a decade, investing in their sectors. Now the rents that are paid in these modern purpose-built primary medical properties, GP surgeries effectively, are higher than the rents that the GPs would pay perhaps in a sort of converted 1930s semi. But it's better value for the NHS in that you can do, and this is very timely and will continue to be, diagnostics and other sorts of testing, because there are bigger facilities, easier to clean, easier to have the sort of outpatients type services that you might have had, for example, at cottage hospitals that have been closed. So these modern surgeries, which would often include pharmacies and allied services, take in a lot of the cost and a lot of the space that would have gone in secondary healthcare properties, i.e. hospitals. So they are definitely, distinctly, A, better value for the NHS, and B, they are providing that sort of diagnostics and testing and getting people out of bed blocking facilities. If you look at the next one, it's a bit broader range of assets. This is a little bit, had a more difficult time in the past year. It is called Secure Income REIT, but it happens to invested in a range of assets, which do include leisure assets. And those obviously have seen a bit of a downturn, but the leases are very long, and the company has extended some of the leases, had some rent freeze, but Secure Income, to be fair, is in a bit of a more difficult position, but the shares have not done too badly. The next one is Supermarket REIT. Again, the supermarkets have found that the actual physical supermarkets are an essential part of the distribution hub through either click and collect or the delivery in the vans. So fortunately, the evolving landscape for supermarkets keeps these superstores right at the center of what they need to do. And again, the rent is quite a low proportion of the whole turnover of the supermarkets. And although supermarkets clearly have relatively modest margins, the rent is not a key determinant of that. Then we've got a couple more to touch on to give a flavor of where this basket is invested. The next one is urban logistics, which a bit like Tritax Big Box, but a very different part of the distribution chain. This is the last touch, the last mile, much more the urban centers, where you have your delivery van or your delivery bike or whatever picking up the parcels. It's interesting here because a lot of the leases are sort of 4 or 5 year leases, but the overwhelming majority of the tenants have stayed in these buildings for 10 plus years. So clearly their tenants are happy to renew the leases. The rents are slightly rising. And therefore, if they're renewing them into rising rents, the tenants are obviously finding that these hubs are an essential part and not an expensive part of their whole business model. And so therefore, this gives a flavor, I think, as to how we're looking. Obviously, investors have got to look at each individual REIT. What the basket is trying to do is point them to a range of REITs that have different sort of exposures, but that all have these sort of characteristics: the long income, the value for money, the paying the dividends. That's all something that we are trying to get as a common thread.
So you previously talked about investment into key worker sectors. What are the positives investors can take away from this in relation to the suggested REITs?
I think that we talked about the value for money, and I've mentioned that a lot of the physical assets are an essential part of what the tenants do in terms of their business. And we mentioned that, you know, you can't be perfect in this, and so Secure Income, which we still think is well invested, has got those leisure assets which you know are more testing. But key worker, to our mind, means that effectively, apart from that Secure Income, which is one of the 17, one of the bigger ones, apart from them, physically 99% of the assets have been occupied throughout the whole, you know, of 2020 and the difficult times that we've had. So, you know, it's not like offices or shops. And as I say, we put together this index about 3 years ago, clearly without a view on the pandemic, but we did put it together that these were essential parts of the whole business delivery of growing clients. So the logistics sector is growing, the NHS is growing, leisure we thought was, but we were wrong there. Supermarkets are growing. So the key worker means that they've stayed open, but we've tried to bias this index towards growth areas as well.
Okay, thank you. So Mike, I think we've got time for some closing comments.
So this is a large sector. Investors can define it as they will, but we've tried to define it on the basis of REITs, which should be not entirely bomb-proof, but should be proof against dividend cuts. The market has tested them, and they've virtually all come out well. If you put it in a package, they've all come out well, because you would have actually made money in absolute terms this year. It's a liquid sector, 14 billion market cap, with about 10% of that having been raised by investors wanting to put new money into 8 secondary issues and 1 IPO. You've got 2/3 of it, which is derived from tenants who are pretty top quality covenants from the government, slightly downwards. You've got over half, which is index linked. So it has proved its worth in difficult markets, but it's also gone up in the past month. When you've had a bullish market, it has gone up by 10%, and it's gone up, made you money in 2019, 2020, and indeed in previous years. Might not do in the future, but in a way, we were worried that one of the main risks was relative underperformance in a bull market, and that hasn't really been the case in the past month.
All right, Mike, thank you for working through your brilliant sector note with us today. And thanks to everyone watching this episode of Hardman Talks. If you'd like to read a copy of Mike Foster's research note on safe harbour REITs, you can visit www.hardmanco.com/research. You can download it from there. We do hope you found this helpful, and if so, please don't forget to hit the like button for this video and subscribe to our channel. We hope to see you back here soon on Hardman Talks. Bye for now.